Good afternoon, everybody, and welcome to the Blockchain Digital Finance Seminar Series. Today we have the pleasure of having Dan Robinson from Paradigm. Just for future references, we have another talk next week by Will Conk, and this will be the last talk of this series. Sorry, of this term. The series will continue next term. And just a few words of introduction about Dan. So Dan Robinson, he works at Paradigm, one of the major investment firms in the Web3 and crypto space, and he is a general partner and the head of research there. Before working at Paradigm, he was a protocol researcher at Interstellar, and before that, he was a lawyer, and he got his degrees from Harvard. Without further say, Dan, the floor is yours.
Thank you. So I'm going to be talking about Uniswap v3. So first is some background on decentralized exchange, which Uniswap is an example of. So decentralized exchange is a kind of decentralized application, arguably the most popular type of decentralized application out there. A decentralized exchange allows people to do the most popular thing in crypto, which is trading one token for another token or trading a token for an NFT directly with counterparties without having to have a central custodian or intermediary on it. So some of the advantages of doing your exchange through a decentralized exchange, one thing is non-custodial, you don't have risk. Sometimes people may be aware of some cases where exchanges that facilitated trades turned out not to be holding all the tokens that they told people, their users, that they were holding. So decentralized exchange reduces that risk. They're censorship resistant. If you can use Ethereum, you can use Uniswap. There's nothing that the Uni token or Uniswap, the company, can do to stop you. It's permissionless, by which here I mean any asset can be traded on it. You don't have to go pay a huge listing fee to get your asset traded on Uniswap. It's convenient. And sorry, maybe just to back up quickly, I should mention I do work at Paradigm. We're an asset investment firm. We have a lot of investments in companies in this space, including Uniswap. I'm certainly not giving any investment advice here, and have all sorts of conflicts. And again, I'm going to hope that you guys are listening to the content of my words and not just sort of taking what I say for granted, because I'm full of biases here, but hopefully my case is compelling in itself. I think they're convenient. If you are doing something on-chain with your assets, you don't have to deposit them on-chain in order to trade them. You can just trade them directly with Uniswap from your browser. It's programmable, and here specifically I mean when you have liquidity listed on Uniswap, it's visible to other smart contracts that it's there, and that can make it really easy to, for example, incentivize liquidity on Uniswap. And finally, it is atomic. It allows you to do trades on Uniswap that are dependent on other on-chain actions, and only either both of those actions will take place or neither will, and that can be very useful for doing certain things on-chain, such as arbitrage on-chain. So specifically, I'm going to be talking about a type of decentralized exchange called an automated market maker, of which Uniswap is one example. Automated market makers are the dominant way that people do decentralized exchange of fungible tokens. Over 90% of volume on Ethereum of DEX volume is going through an automated market maker of some sort. About 70% of that going through Uniswap. The way that an automated market maker works is that market makers deposit assets into a pool which automatically provides liquidity to others, so traders can come in now and trade with that pool. So just to talk a little about how that works, there's a pool contract that holds all the tokens that people have want to provide liquidity with. Liquidity providers can come in, contribute to that pool, and what they get out is a token that represents their share of that pool. Now, traders can come in and trade this red asset for a blue asset, and the price at which they trade is determined algorithmically by the contract. And then later, liquidity providers can come back, present their token that represents the liquidity, and get the tokens that came out of it. So some of the advantages of doing decentralized exchange through an automated market maker, one is that it's more gas efficient. Typically, if you have an order book on-chain, you'd have to have a transaction to place an order, and then another one potentially to cancel it, and then another. And then every time someone filled an order, they'd have to do it. It would be a cost proportional to the number of orders they're filling. Here with an automated market maker, it's like you're just trading against a single counterparty. Every trade that happens on-chain only has to have constant cost, no matter how big a trade it is. Which is true of some automated market makers, although not. It gets a little hairy when we get a little deeper into it. it's really easy to be a liquidity provider on Uniswap. It's just like a single transaction, there's an interface, and boom, you are actually just providing liquidity. You're acting like a market maker. If you try to do that on Coinbase or Binance, you're gonna have to like run a script that like runs that does places orders and cancels them and replaces them when they get filled. Here it's just like really easy, and so you actually get a lot more retail liquidity provision. And then finally, that programmability that I mentioned, the fact that the liquidity on chain is visible, makes it really easy to incentivize liquidity, and that was big in the growth of automated market makers. So now I'm going to talk a little about how they work at a slightly deeper level. That what I gave you was the mechanics of it. So an automated market maker, when we think about it, it doesn't have to be this, but I think it's simplest to think about it as being a trade between one risky asset and one numeraire. And so with this asset, I sort of usually imagine ETH as the asset, and then the numeraire, think like US dollars. Some AMMs like Curve do support multiple assets, or Balancer, they do support multiple assets, but like those don't fit on a graph and they also don't fit in my head. So I always think about AMMs as just in the 2-asset case. And I think honestly that gets you most of the way into thinking about useful stuff. Like I've never had to worry about three token dexes. So this AMM has some reserves. Like when people have deposited, liquidity providers have come in and deposited reserves, and people have traded one of the reserve assets for another. And that's the main thing the AMM knows about the world. The main thing it knows about the world is what it has. And the idea is, based on what it has, those reserves X and Y, it computes what it thinks the price should be. And it's sort of wild that this works. But the reason it works is if the price is wrong, someone will come in and trade with the AMM, and that provides a signal to it about how the price should update. And so as long as the prices respond in the correct direction to the way that the reserves change, and we'll talk about that in a moment, then arbitrageurs should come in and push the price that is offered to the true price of the asset. There's also some fees that get collected that make it worth actually trading on this. But that's critical to think about, is that at any given time, in equilibrium, if there's no arbitrage in the market, as we all know there is no arbitrage, then the price offered by the AMM must be the true price of the asset, modulo fees. So, all right, let's build our own automated market maker, and we're going to happen to build Uniswap v2 here, spoilers. So let's suppose we want to build an AMM that maintains a 50-50 portfolio of 2 assets. Excuse me. That's just the property that we want it to have. And this is generally when you design a new automated market maker, it's a nice way to start, is just think about, okay, what's the property that I want? And it might be something like this. But you could have come in and said, like, I want like a 60-40 portfolio, and then you would have ended up with a different formula, actually the formula for a protocol called Balancer. But here we're going to be doing 50-50, the simplest one. So remember, P is the price currently offered by the AMM. And as we know, because of no arbitrage, P is the price of asset X in terms of numeraire Y. Because if it wasn't, there's an arbitrage. So the price offered by the AMM, we know, if we also know that there's a 50-50 portfolio, the price offered by the AMM times the reserves of X must be equal to the reserves of Y in the pool, if there's no arbitrage. So this is our invariant that we actually start with. It's just we know that the price times X is going to be Y. So now when we think about what do we mean, though, when we say price? We say the price currently offered by the AMM. What we actually mean is if you were to come in and offer an infinitesimal amount of the asset and wanted to sell it, how much of the numeraire would you get out, right? So another way to think about this is just the derivative of the reserves of Y, the reserves of Y, which is the amount of cash, with respect to the reserves of the asset. Because as the cash goes in, asset comes out. And so the marginal price is just actually the slope of basically the line at that point. It's just the derivative dy dx. In fact, it's negative dy dx, because when one goes up, the other always goes down. And so remember, we had this formula that price times x equals y. Now we can actually just say, replace price with negative dy dx. And you can always do this. Negative dy dx times x equals y. So this is a differential equation. I didn't really study differential equations in high school or college, but it's not that hard, and I learned them to do this kind of work. Turns out that the solution to that differential equation is just y equals k over x. Or if you multiply both sides by x, x times y equals k. And this is the most famous formula in in DeFi probably. And again, you could have gotten this. People wonder like, oh, why X times Y? Okay, why not something else? Well, like this is the formula that gives you that solves for this particular property that you want. Yes.
This is the history of the constant product function. So you're thinking about the history, like there's
It's a great question. I think so. Yeah. So like Alan Liu from Gnosis was the, and then Bancor I think were sort of some of the first people to come up with it. And I think it's a nice property that you might like would be that it's always 50-50 at any given price, right? It seems like the most sort of neutral, uniform formula. So yeah, I think I think that this is, I don't know if they did the differential equation solving exactly, or if they just sort of intuited it or guessed it, but yeah, that's, I think, one of the reasons why this became popular. So, but there are many other formulas that you could use, and this is just one such. So, now just to sort of visualize this a little bit, here's how the constant product market rate works. So you have some reserves of X. We're going to represent the reserves of X on the X-axis and the reserves of Y intuitively on the Y-axis. And our starting state of our AMM here is the point, right? And here we're starting with where it has a state where it has 1 unit of X and 4 units of Y. So 1 ETH and $4. So what we know about trades here is that every trade that happens has to preserve this invariant. And again, we're ignoring fees for the moment. In fact, it would be like greater than K. But here, it's just that every time you move to a new place, the product of those reserves needs to be the same as it was previously. And in fact, this invariant, the X times Y equals K invariant, is in Uniswap v2. It is actually just enforced just directly in the code. There's like a single line of Uniswap v2 that makes that enforces this logic and causes it to be this way, and everything else in the contract is just accounting. This is the actual logic here, and it just says that when we have these new balances, when we multiply them, they has to be greater than or equal to the old balances plus a fee. So here, so now let's imagine what happens when someone actually trades with us. So when suppose someone comes in and wants to sell 3 ETH, right? So what we do is, let's imagine we just move out, increase the amount of X to 4. So here we just sort of move out 3 by 3 ETH out on the X-axis. And then what this contract lets us do is just drop a line down to hit our hyperbola and figure out how much Y we get out. And so here in fact, it's just, we get out $3. So here we sold 3 ETH and we got $3 out of it. And so if you look at this trade, you can think about it as just a line going directly from the starting point to the end point. The slope of that line is the execution price of the trade, right? And here I was actually able to sell this 3 ETH for $3, so I was selling at a price of 1. But imagine if I'd sold a little more ETH. The more I sell, the worse price I get per unit of ETH that I sell. And so here, if I were to sell 5.62, I would end up getting a price of just $0.6 for every ETH I sold. And if you imagine just sort of compressing to like an infinitesimal trade, then what you get is the price for an infinitesimally small trade, as we said before, is just the slope of the line, the tangent line at that point. So that's where you see here, like the starting price was the tangent line at the starting point here, which is just price of 4. And then at the end price here, which is a price of 0.25. So that's the marginal price, the price for an infinitesimal unit at the very end or beginning of your trade. Anyway, so that's AMMs. Like I could sort of go on and tell you about other curves, but yes.
Real quick on the previous slide, Dan, can you tell us what determines that curve? That's the basis of the exchange rate.
The curve, the hyperbola, the pink curve here. So the shape of the curve is determined by the fact that we're using the X times Y equals K formula, right? So like that's just X times Y equals K. It draws a hyperbola. That's just what that curve is. If you used a different curve, it would be shaped differently. Where it starts, that's determined by your initial conditions. Suppose some liquidity provider comes in and provides some quantity of each asset, right? That's going to uniquely identify some particular hyperbola in the quadrant. So if someone had provided, in this case, someone provided what we call 2 units of liquidity here, where like x times y equals 4, because 2 is the square root of 4. If they provided more liquidity, then it would be sort of the curve would be out there. That we'd say there's more liquidity in it, but that would just be, you think of that as the hyperbola being sort of like translated and scaled out to the right.
Totally. So, but adding liquidity would simply shift the curve. It wouldn't change like the convexity of the curve.
That's right.
Uniswap, or does Uniswap specify that convexity itself?
Uniswap V2, Uniswap V1 and V2, that use just the constant product market maker, there the convexity at any point is just determined by the formula. So it's not constant convexity in like the formal sense of convexity, but in the way that I define like liquidity, like the curviness of it, I say it's like constant across that whole space. But it's a great question, and we'll talk in a moment about how to free ourselves from that restriction. Because yes, it's very opinionated to say like this is exactly how this should be shaped everywhere. Yes.
So I understand this on a per user way. I've just always wondered in practice, everything happens in discrete time per block, and then you have many traders coming in the same block for a trade. So how does that impact the determination of? Because like I get a price with respect to liquidity, but somebody else is also simultaneously trading. So I'm just
So it's a great question. So the way that Uniswap works is trades are just processed in the order that they're included in the block, which typically is based on just descending fee order. But where you're included in the block could mean that you start with a different price, maybe a worse price, maybe a better price. And in fact, a lot of the issues, and I'll talk about this in my next slide, a lot of the issues with DEXs are based on how sort of unfairness and how transactions are processed in that way. But in particular, there's ways for someone to make money by causing you to get a worse price, potentially.
But that I don't know. So I guess the way it's implemented, it's as if like based on fees, whoever goes first.
Based on transaction, on like gas fee.
Gas fees, whoever goes first, like the MEV bot moves it along the curve, and then everybody else is now that's their starting point, and you just hand it off to the next user on the next.
Yep. Was there another question? All right, we continue. So I could go on with the, sort of how AMMs work, and there's an infinitely many functions out there, right? Like literally like any convex descending function could be used as an AMM. And like people do use it. There's a constant sum market maker. There's constant power sum market maker is one that I worked on at one point. There's constant geometric mean. There's a lot of sort of like interesting constant function or just AMM designs. There's literally more than there are functions. As many as there are these descending curves. But I actually don't think that's where most of the alpha is in AMMs, because a curve is just, if you think about it, like it's a particular strategy for providing liquidity on effectively an order book. And if you're providing liquidity on like a central limit order book, like Coinbase or Binance, you could choose like any algorithm you want for doing this. It's probably not going to be shaped like this constant product curve, but it may not be shaped like any particular curve at all. And so we want to, there's no necessary reason why like one is necessarily better than the other, or that there is like one that's sort of like the dream perfect function. At least not in my opinion. And so. I think actually when we think about DEX features, we want to be thinking about ways to sort of like do better regardless of essentially the function that people are using to provide liquidity. And so here's some ways that I think you can actually improve sort of automated market make design. So one is just to reduce just transaction efficiency, gas cost. That's just the cost that it takes for everybody on this network to be computing effectively the calculations involved in your DEX. If you can reduce that, that's just win for everybody. It's more efficient. There's just less work being done. You're paying less in gas, taking up less space in the block. So that's just a positive sum improvement for everyone. Another way that I think value leaks from this whole system is slippage. So that's what slippage is if you go to trade on this DEX and somebody trades before you, and the price is now worse than the price that you would have gotten. And this can happen by accident or just by bad luck, but it can also be enemy action. It could also be somebody has come in and caused you to get a worse price, and there's a reason someone might want to do that, which is what's called a sandwich attack. somebody causes you to get a worse price so that they can trade basically the AMM back after you've traded, and they end up locking in a profit by doing that at your expense. So trying to prevent that. And that's really about getting, that's a harm that happens to the trader. That's about getting the trader the best price possible. Another one is this phenomenon called loss versus rebalancing, which is value that is leaked out of, effectively out of the pool at the beginning of every block when somebody comes in. When you imagine this AMM pool, right, it's offering a price that was efficient at the end of last block by assumption. We say, during every block, like it gets arbed to the right price. But the price changes, it's being traded on Binance or some other exchange constantly. And so at the beginning of the next block, there's potentially an arbitrage where someone can come in and trade it to the right price. And if they do that, they're making some profit, and liquidity providers, typically are losing some money. And so CMAC and some others have a paper on this. I love this term. It's called loss versus rebalancing. And what that really is about, it's about this value leaked. And that's a cost that's suffered by liquidity providers. So when you're providing liquidity in this passive way, you are just losing money effectively every block because you could have been doing the same strategy on Binance a little more profitably without the sort of negative adverse selection against you. And then finally, the other way that automated market makers could be improved from Uniswap v2 is capital efficiency. And the thing was, if we looked at like this curve, you're providing liquidity effectively like everywhere. And so the question is, that's probably not efficient. Like most of that liquidity is just not going to be touched. And so you've just got to put in a ton of extra assets for just like no reason. And so this was actually the problem that we decided to focus on when we were working on Uniswap v3. So now we'll talk a little about concentrated liquidity and how Uniswap v3 works. So before that, any questions on these topics? Yes.
With slippage, is there a way to compare like arbitrage in trade placement in public equity markets to what you would see right now in these markets?
And what do you mean by a way to compare it?
Like right now, if I'm making a trade, there's the risk either on an AMM or on public equities markets. There's a risk that someone else, like the market maker, is able to arbitrage my trade, right? Exactly like what you're talking about. So
yeah, it's worse generally on blockchains, or often is, because like often transactions, these trades are put into the public mempool, so they're visible to the world. And so someone can come in, they know what you're going to trade, and they can potentially act on that information, right? So you're leaking some information. Additionally, they can cause you to get a worse price in a way that directly benefits them because they push your price up, you get a worse price, and then they trade back. Like that's sort of not exactly a phenomenon that happens because you don't have these AMMs that automatically trade in both directions. Here, just mechanically, by sort of causing you to get a worse price, I'm causing you to push the price up into a zone where I can then like trade it back. So yeah, the answer is roughly like it's sort of like worse by default than even what you have in the public equity markets.
How much time do they have for that?
It depends. I mean, on when your trade transaction is submitted. So like typically now in Ethereum, like blocks happen every 12 seconds. But yeah, I mean, I think it could be. It depends on when your trade is actually submitted. But generally, like enough time is the answer. Yeah. So we're talk a little about capital efficiency. Okay. So how did Uniswap v3 come about? So the thing was, it was exactly what I was just saying. Is we realized, when you have this curve that's providing where people have to provide liquidity at effectively every price. With the constant product market maker, it's like 50-50 portfolio at any price, which means effectively you're waiting to trade a lot of your assets unless the price like goes like really far. One example of this is, or a way to sort of visualize this, if you're providing in the constant product curve, then 1/4 of your assets, 25% of the stuff you have down there, doesn't get traded against unless the price moves by more than 16x in either direction. So if price just stays within the same like 16x up or 16x down, if it doesn't move more than that, 1/4 of your assets are just wasted. They're not even going to be traded against. So it's just pointless to make you put them in there. So that was why we were thinking about it is, okay, can we take what sort of works about Uniswap v1 and v2, but make it more capital efficient to provide that. So what we do is to start with the constant product market maker. Again, this is this hyperbola. Hyperbola is the name of this shape. Imagine we were to just translate it down and to the left. And functionally, that means when someone trades with you, the deltas, they all act the same within this price range. When someone trades with you, and by the way, this is in the Uniswap docs, we have like interactive visualizations for all of these, so you can play around with them yourselves. Links to ones of these on Desmos, or just Google like Desmos Uniswap, and you'll get a bunch of my Desmoses for this. It's a graphing calculator, it's great. But so imagine we translate this curve just down to the left. So for trades within this range, this acts exactly as if you were providing the greater amount of liquidity, right? And like someone trading with you just wouldn't be able to tell because they put in the same amount, they get the same amount out as if you were up here. But if you were to go out of this range, and so here, like I have the prices here are the slopes of the tangent line at those points. If you go out of that range, I'm no longer providing liquidity. You can't trade with me. The benefit to the liquidity provider here is they don't have to put in as many assets. So like you notice, like there's just both X and Y are lower at that particular point. And so this is more capital efficient for them. But they're just, you sort of like look at this graph of log price and liquidity. It's like imagine they're just providing liquidity in some particularly narrow range. So here I've just sort of like drawn out that graph. Just imagine log price on the x-axis and like some notion of liquidity. And liquidity here we define actually like the square root of k basically for reasons. But here you're just providing it on some particular part of the curve. Now, that would be fine in itself, but like imagine like everybody who wants to provide liquidity has to create their own one of these like translated curves, and and in order to trade against them, you have to like trade against all of them. But now imagine we just have an efficient way to actually combine it with a bunch of other people's liquidity. So you can just say, I'm providing in like this range, but someone else could be providing in this range, and where they overlap, they all sum up. So if you see here, yeah, like this is like a graph, and you can see this animated if you go to the Desmos. But at this particular point, like everyone is providing some amount of liquidity, but if price were to go up, other people would provide less. And so that pink line there is just like it's the curve formed by the sum of all four of those curves. It doesn't have any particular formula in itself. It'd be this weird like piecewise non-differentiable function, but that's what it is. So here you sort of imagine just a bunch of different horizontal lines that are sort of stacked on top of each other, and these are different people's liquidity in different positions. Okay, so that's how Uniswap v3 works in a nutshell. But that's how we historically did get there. But actually, there's another way you could have imagined that we could have gotten there, and that would be by saying, all right, let's take the sort of dominant form of market making in like traditional equity markets, of the central limit order book, and let's just try to do it on chain in a way that is more gas efficient. CLOB means central limit order book. So let's start with here, central limit order book. This is just sort of imagine like the bids and asks stacked, and the size of them sort of stacked on top of each other here, and the current price is in the middle there. That's the sort of midpoint. So one thing with central limit order book is if you want like greater price precision on a central limit order book, you have to like have a lot of ticks. A nice thing about the AMMs on chain is that they sort of have infinite price, or very, very fine price precision, modulo fees. But we can actually get that with the central limit order book by just saying like instead of you providing out like one particular price, we're just going to smear it out a little bit in price space, so that when you're trading against someone's order, you're actually like sort of constantly pushing the price a little bit down rather than having like one price and then you move to the next tick. All right, so that makes it a little more gas efficient. It means our ticks can be a little wider without having to lose price precision. Then let's say, look, it's inefficient on central limit order books when you trade against one, that every time you trade against an order, it disappears from the book. So let's say actually a new kind of order called like a flip order, where if you place this on a central limit order book, every time it's crossed, we'll turn every sell order into a buy order or vice versa when it gets crossed. And so here I just have a picture of, like it's both of these things are no longer buy or sell orders. It just depends on which side the price is on. And then let's say, okay, suppose you want to just provide a lot of these orders across a wide range of prices. On chain, it'd be inefficient to do this just because like it's expensive to do a bunch of different transactions. If you want to like do a strategy where you provide a lot of liquidity on a wide range, let's create an order type where you can just sort of like click and drag, and now we have a lot of these orders. And here we go. Now we've just re-landed on basically the exact same design. It's the same picture, just coming from a completely different direction. All right, any questions about concentrated liquidity? Yeah, so this was sort of controversial because one of the big benefits of Uniswap v2, and I would go out and like sort of proselytize for this, was like, oh, it's nice, it's one simple strategy that anybody can do by just providing liquidity. I said that, right? It's like really easy for retail market makers. This is not as easy. This means you might have to be a professional market maker. It means if you're like an ordinary retail market maker, you might be able to like you'll be able to participate at least a little. You can like create liquidity and you'll get traded against pro rata. But in order to like really efficiently provide liquidity on this, it's more competitive. Now, mind you, like that's essential for Uniswap to stay competitive and provide the best experience for traders, for swappers. But this was sort of controversial at the time. And again, I think now people have recognized that this was inevitable or some kind of change like this. Yes?
So if you're competing in a traditional limit order book and you're like a high-frequency trading market maker, there's sort of two ways you would compete. One is you're going to make predictions of prices. Like if you think the price is going to go up, you're going to bid more aggressively than your offer. The second is you're going to make predictions of adverse selection, right? Based on, let's say, what volatility is, you're going to widen or narrow spreads, right? It seems like you can do neither of those things in Uniswap v3, right? So let's say you're a really intelligent a market maker, right? What would you do? Is it just about like keeping your order in range and minimizing capital, or are there more sophisticated things you could do?
I mean, so I would push back on whether you can do that. For one thing, another feature that Uniswap v3 offers is the ability to choose which pool. I haven't talked really about fees, but the level at which you set fees it sort of determines basically the bid-ask spread. And Uniswap v3 actually does allow you to pick different. There are different pools for fee tiers, but relatively coarse, yes. But I mean, you can put in liquidity and remove it, and I'm going to be talking in just a moment about like one such strategy for doing so.
Got it. So you could do the same thing in V2. It would just be capital inefficient because you'd have to put in a lot of the same.
Yes, that's right. And similarly, again, like what we're comparing it to here, recall, is like providing liquidity in like the full range. We're just providing like way lower liquidity for the same amount of money. And so like you don't have to do an incredibly sophisticated strategy to have a much better experience with V3 because you're just like providing in a somewhat narrow range. Again, you get like sort of save 25% of your assets by just not worrying about the case where prices move 16x up or 16x down. Yes.
So another way to think about B3 is that the market makers are choosing the complexity. Right?
Are choosing, sorry?
The complexity of the curve.
Yes, so exactly. So the benefit is you can choose whatever curve you want.
Pooling type of liquidity where everybody's using the
Yes.
same now.
Yes. You get to, You get to choose. We can choose any strategy. It could be based on
Some market makers want low pricing, but some others want high pricing.
Yep. Yeah. So the real answer there to like how do people make money is like I don't know, and I don't it's not my job to. I would not be able to make money trading on Uniswap V2 or V3 or anything. Like the goal is to try to create a game that competitive people come in and compete on. Now we were just talking like I'm actually not sure who or how people make money on Uniswap v3 these days, and it seems like a lot is going very competitive. But again, like I'm not sure what the best strategies are. But you can do a lot. You can do a lot in terms of adding liquidity, removing it, and we'll be talking about one strategy, a sort of one of the simpler strategies for doing that actually in just a moment. Yes.
It seems like there's a spectrum between pure AMM, let's just say constant product in its simplest form, and then on the other side you have a central limit order book as it exists in traditional markets. And some of these adjustments are due to the frictions of being on the blockchain, right? With Ethereum and block times and things like that. Do you see? Again, I think of them as sort of living on a spectrum. Is there any way to targeting you're optimizing for something, but optimizing along that spectrum of pure AMM and pure central limit order book? Like, are there certain markets where an AMM, a basic AMM, is maybe better than a central limit order book for whatever reason? It's sort of a broad question, but I'm just thinking of, abstracting away from the frictions of the blockchain and how do we, hone in on whether this is a true innovation or are we just working around some constraints that may or may not go away?
Oh well, yeah. So the goal, I think, the goal of Uniswap v3 is to try to be a hybrid that gets you the best of both worlds, and particularly that it it lets you, if you want, on any particular pool, you could treat it like, you can actually just use Uniswap v3 like it's a Uniswap v2 pool by creating a full range position. So if like maybe in some cases v2 is better, fine. In that case, just create a full range position on v3. So it supports that, and it lets your liquidity be aggregated efficiently with people who are doing different strategies, right? So we're just sort of not making like a top-down decision about what the best architecture for this particular one is. But yeah, certainly a lot of the design choices about v3 we would do differently if, for example, if like transaction costs weren't a thing or weren't as expensive on chain, right? And so I do think. Yeah, I mean, I think in some cases, like if transaction fees were really low, we would probably design it or negligible, we'd probably design it differently. But I think you're going to have. Put this a little more softly. Yeah, I think, especially with DEXs, like competition for inclusion of transactions is sort of always going to be a thing. It's these sort of maybe inherent properties of being on a layer 1 DEX that mean that you might have to cope with some of these limitations. Yeah, so that's why. But, I'm not married to that, and generally, like, yeah, I think our DEX design should change as the circumstances change. Cool. All right, so like I said, concentrated liquidity was kind of controversial. Now it's recognized that, like it or hate it, like it is a more competitive evolutionary form of a decentralized exchange than non-concentrated liquidity. And so it's most of the volume on Ethereum now goes through Uniswap v3. Okay, so we're going to talk about another kind of controversial part of Uniswap v3, and that's a phenomenon called just-in-time liquidity. And I think this is illustrative of where a lot of DEX research is going, and what I think is most interesting. But it's also like just a rant on my behalf. And again, I said before, I'm like very biased on this. Just assume like I've disclosed like a billion conflicts, but. So you won't get like an unbiased, neutral perspective out of me. What you will get is passion. That's the trade-off. Is you got someone who's. I've been arguing about this, and this is a brag, but I've been fighting about this longer than anybody in the world because I was fighting about it like long before Uniswap v3 was released publicly. I was thinking like this is good. This is fine. Like this, I had a strong position on this relative to a couple other people that I was working with this on who work at Uniswap. So it's a long rant I've been on for a while. All right, so what am I saying when I say JIT? What I want to hear is just-in-time liquidity. It's a phenomenon that's a particular kind of a peculiar sandwich. So here's how a traditional sandwich attack, I mentioned this before, works. The idea is some user comes in and they want to buy some token. They publish this transaction to the public mempool, and then which means anyone can see it. So when an attacker sees this and they say, okay, they're going to buy on the AMM right before the user does. So they're going to include the user's transaction included in a block, but first they're going to get their own inclusion, their own transaction included, and that's going to push the price up. That's going to make it worse for the user. Now the user is buying. They get a worse price than they otherwise would have gotten, and in fact they then push, by doing so, they push the AMM price even higher. Afterward, the attacker now gets to sell into the pool at a higher price than they had bought. And if the trade sizes are right, and the trade causes more price impact than the fee, there's some conditions under which that have to be satisfied for this attack to work and be profitable for the attacker. But if the conditions are right, the attacker has now just locked in a risk-free profit by sandwiching the user at the expense of the user. The user has gotten a worse price. Okay, that's as I said before. That's generally we consider that bad, and this is like one of the areas of DEX research is how do we minimize those attacks. But what is JIT? So JIT is a different kind of sandwich. It's like a delicious positive sandwich. So with JIT, what you do instead of trading before a user. Right, so like before, it's the same thing the user is buying, right? But instead of trading, you're actually going to mint liquidity. You're going to put in more liquidity. You're going to make the order book deeper on chain by adding liquidity. Now you could have done this in V1 and V2. In V3, it's just a lot easier because it just takes much less capital to add liquidity because you just add liquidity only at the very concentrated range. So attacker comes in, puts a lot of liquidity in. Now the user trades against them. And and gets actually a better price. And then the attacker pulls out their, because the order book is deeper. They've provided liquidity. Now the swapper comes in and is buying, and then the attacker pulls out their liquidity. All right, so what happened here? Like, why did the attacker do this? The reason is if the user was getting like a bad price for the user, like they were paying too much, now the liquidity provider, the attacker, can come in and provide liquidity so that they get to basically trade against the user because the user's like crossing them. So now they get to trade against the user, and then they can pull the liquidity. And now they've traded against the user at a better price than they would have been able to get elsewhere. So maybe they're arbitraging this somewhere else. Yes.
So you're putting kind of a positive spin on it.
I am.
It's there for-
Don't worry. I'll give the negative spin aside.
But it's hurting the LPs.
Right. So who's being hurt by this? Why isn't this just like win-win-win? Right. Well, the answer is there's some opportunity cost here for the liquidity providers, the passive liquidity providers. Right. All right. And so because you're providing a lot of liquidity, you may be like flooding the pools, and now maybe you're like 90% of the liquidity in this that the user's trading against, right? And so now the other liquidity providers don't get to do this trade. They don't get the fees from this trade, and so effectively we're diluting them a little. Yes.
I'm trying to understand why it's bad for the user.
It is good for the user.
Why do we call it an attacker?
Yeah, it's a great question. Because it hurts the passive liquidity providers, arguably, because if they had gotten that volume, they would have gotten more fees, right? So yes, so that's again, I put this positive spin on it, but like people hate this. People go nuts over it. People like just, they're really here's like just some sampling of the Twitter response. But people think, oh, this like ruined liquidity version, because if you're a passive liquidity provider, it's like you're now it's much easier for someone else to come in and basically be taking some of these juicy fees from you by providing liquidity for just a moment and not taking any risk. So people got really upset about this. All right. So first, I'm going to make a case. I think people way overestimate how much this actually affects Uniswap in practice. And so I did a poll last summer. Actually, at the time, the right answer was like less than 1%. Now it has ticked up a little. But like it's like max like 3% of Uniswap volume is traded against any legit liquidity, and that's not even counting like whether that volume like was what percentage of it was traded against. It's just assuming like if this volume was traded against any JIT liquidity, I counted it toward this, and that's 3%. So still like very small relative to the total amount of volume on B3. Yes.
You have some visibility of who are the just-in-time liquidity providers, which company?
I'm sorry?
Who are
Who are they? I mean, they're anonymous publicly.
Yeah, no, I know they are not.
What's-
You have a sense of who they could be.
It's some sense, yeah, but it's a professional market makers effectively. Yes.
Is this a function of gas fees? So like on roll-ups, we should see more of this than on.
Yeah, it's a great question. People have asked that before, and I haven't looked into it. You may not have it on roll-ups, and the reason is that most roll-ups right now don't have a mempool, and so you actually can't see other people's transactions.
If we get to like actual permissionless sequencer sets and there's a.
Yeah, if there were really low fees, you might expect to see more JIT. That's possible, yeah. But right, so it's a really expensive way right now to do this kind of order improvement. But yeah, so people like really overestimate it. But then I'm going to bite the bullet on this one. I'm going to say actually, not only is it overestimated, but like even if it was like 50%, even if it was like 90% of volume, it is good. I'm glad that it happens, and I don't think we should be trying to fight it. All right, so why do I say this? First, what we said before, it's good for the swapper. It's order improvement. This is someone is coming to trade on your DEX and they're going to get a bad price, and this hero JIT provider comes in and gives them a better price than they otherwise would have gotten. So it's giving them like some slight bit of order improvement by increasing the depth of the order book when they would have gotten a bad price. Second, it's like a really expensive way to do that. It requires, somebody's coming in, they're trading, and then I've got to sandwich their trade with two expensive transactions, like providing liquidity and then removing it right afterward. That's a lot of gas. And so it is only going to happen if it's like a really bad trade. And in fact, you could think about it as just like a really janky way of doing what's called like request for quote, which is a different kind of market structure where somebody goes out and they say, oh, what price can I get for like trading this asset for this asset? And if somebody, whoever gives them the best quote, it gets a trade against them. Here, yeah, like if they're going to get a really bad trade on the DEX and someone comes in and they're like, I can do better by jitting you, it sort of seems like, okay, like let's give it to the user. And this is part of my philosophy, is like, I do think the end user of Uniswap, the end user of DEXs is the swapper. It's the person trading against it. It is not the liquidity provider. We're not doing this for the liquidity provider. We're doing it for the traders, and that's the people who we're trying to optimize the system for. But I'll make a slightly different point, which is this order flow that's going to the DEX. It doesn't belong to you, to Uniswap, right? It doesn't belong to this particular DEX. It's a trade that was going to get a bad price there, and like, yeah, maybe this trade is going to you, is going to use you, and so like, if we give you a worse price, that's better for our passive liquidity providers. But ultimately, that's relying on just people being irrational or using bad technology or being inefficient, right? If they could be getting a better price somewhere else, whether by using a DEX aggregator or using an RFQ system, if again, like, if there's somebody out there, this jitter, who wants to trade against them at this price or better, like, if you're giving them a worse price than they could get elsewhere, you're just not going to keep that person as a user. And long run, we're not going to be able to count on that kind of volume. And so I think if you were to disable JIT liquidity, that just accelerates competition from other sources. And so it's kind of a safety valve that keeps it actually competitive. And so, I do think that, so that's sort of the practical case, but I think there's kind of a moral case here, which is somebody, this user, this poor innocent person is just like yeeting volume into your DEX, like hoping for as good execution as they can get. And if we were talking about like disabling JIT liquidity, right? There's ways you can do it. There's ways you can like have like withdrawal fees or withdrawal delays to like prevent people from doing this. But if you're like building your DEX in order to like make sure that user doesn't get a better price, so that your passive liquidity providers make more money, like that's just not a sustainable strategy in the long run. Yes.
Well, I think just building on your point, one big difference between jitting and a sandwich attack is a sandwich attack is like an atomic arbitrage, right? They're not taking any risk. Right?
That's right.
In jit, you're taking a risk.
You are.
So you have to offload it somewhere. So in some sense, if you're taking a risk and adding liquidity, and you're getting compensated, maybe that's okay.
That's exactly right. You are taking, yes, you're taking some risk. You could do it atomically on chain. Like you could be doing a JIT liquidity transaction atomically with a like trading on some other DEX or something. But like, yeah, but the point is it's not exactly. It's not like just extracting something from the user. It's like getting a good price because you can get liquidity somewhere else. You're sourcing liquidity effectively for the user. Yes.
Is the question, does it really boil down to, I'm thinking of two, right? So you still have Ethereum and, block ordering and things like that. If there's a JIT order, let's say, which gives somebody a better price, and at the same time, there's someone trying to sandwich that same trade, it is more profitable for the validator to include the sandwich attack.
Yeah.
And JIT, and I mean, if I'm running a validator, I'm going to accept the MEV or the sandwich.
Whichever bid's higher, yeah.
So I'm just trying to, I'm thinking out loud of the interaction, like,
Yeah. And it's a good question. And I think it is possible, yeah, for a transaction to be both JITable and sandwichable. But yeah, again, I think there are a lot of like block builders who just will not sandwich, like they're ethically against it, but do JIT. So at least that's my understanding. So that's one reason you might not get it. But yeah, but I think, but again, I think we should solve sandwiches. Like I think sandwich attacking is bad, and we should build better features that prevent it, or improve front ends and things like that to avoid it. But like, yeah. But my point here is like JIT again. It's a symptom that like you're actually the user's getting a bad price, right? So that's sort of to bring it back. That's like I think we just have this sort of moral obligation effectively when we're designing DEXs to not be saying like let's just give users worse prices than you get elsewhere in order to help subsidize our passive liquidity provision, right? You actually, if we're going to keep passive liquidity sustainable in this whole model of on-chain liquidity, which I think is beautiful, and I've been a big fan of it for years. But if we're going to keep it going, it has to be built on a more solid foundation and built on less of a negative sum game than just saying like, oh, if users send transactions your way, we're just going to give them worse prices so we get more fees. I think that just doesn't that isn't like a good foundation on which to build this. So again, I think we're reaching a point where users will go elsewhere. The competition is rising, and like I think we're not in 2019 anymore. We're sort of in these liquidity wars, we're actually starting to see real competition for order execution, for liquidity. And if you're not providing the best value for both swappers and for liquidity providers, but again, really what matters here is getting the swappers and giving them the best price. You're just not going to survive. And so in these liquidity wars, I think ultimately we're going to have to design features, and I have some ideas for them, but that's not what this talk is about. That are a little less negative sum than trying to like stop jet liquidity. Yes.
Can you talk about what's the analogy in like centralized in not the crypto world to JIT attacks?
I mean, there's high frequency trading generally is sort of a similar phenomenon, where if I'm if you imagine someone quoting like a tighter spread, if I'm providing like liquidity passively on a book and somebody's faster than me, then they're going to be like only providing better liquidity. They're going to provide better liquidity than me when like in fact that's a good trade to do and not when it's not. So like I'll be only getting adverse selected trades. So
Is
like
it-
on score to flow.
Is it like a perfect analogy, or is there an element of there's something misaligned there?
I mean, JIT it's like the way of kind of really squeezing this concept into like a very weird form in order to make it fit with how DEXs work. There is, I mean, but there are some reasons why it works when it doesn't work as easily on centralized exchanges. And one of them is price time priority, where like typically on a central limit order book, if I place an order at the same price as you, but after you've placed it, your order will be filled first. And so you have to actually like, be tighter toward a tighter spread in order to like snipe this trade from me. Whereas for technical reasons, I don't think that's possible to efficiently implement on chain in Uniswap v3 in a model like Uniswap v3. And so you get filled pro rata instead. So if I'm providing like liquidity at the exact same price or within the same tiny bucket as someone else, and I came in after them, we still both get the same percentage of the fill. I think that makes it a little easier to do this kind of attack, quote unquote attack. But yeah, and probably I would change it if we could. But I think it's not I don't think it's implementable. Yes, other questions? Yes, that's all I have. So other questions? Yes.
So if active liquidity is the opposite of, I guess, just-in-time liquidity, like the strategy is different, so why was it introduced as a new mechanism in V2?
Why was? I mean, you could actively. Sorry, what was the first part of the question again?
It was just so was just-in-time introduced in just to
No, so you could do just-in-time liquidity. It just wasn't very capital efficient. Like it would require like billions of dollars to do very effectively on Uniswap v2 because you have to provide liquidity everywhere, right? And you only really want to provide liquidity right where the user is trading. So v3 just makes it much more practicable to do.
Wait, so was active liquidity introduced in V3?
What do you mean by active?
Like where if a user puts in a trade and then the range moves out of their supposed like range, then they pull it
Well,
up.
so in V2 there was no ranges, right?
Oh, okay.
Yeah. So that's the.
So was it introduced as a way to protect passive?
Well, what was the entire concept of ranges was introduced in order to give liquidity providers more capital efficiency, and I think downstream it causes some strategies to work that are more active than would have been in V2. Does that answer the question? And it might require more active liquidity provision in the sense that, like, if you're providing liquidity at a particular range and the price moves, you might have to like move your liquidity in range. Yes.
Kind of a random question, but what's your take on like dark oracles, block native, blocks roots?
I'm not sure what's dark oracles.
Just oracles that kind of like hide the price. People that are trying to not get arbitrage, not get segmented.
So like private mempools and stuff. Yeah, private relays. I think it's good. I think it's and it is useful. Again, like I think sandwich attacks are bad, and we should try to be fixing them. And I think we're working on trying to prevent those. I think it's like basically purely extractive. I think and so one way to solve it would be you submit it to a private your transaction to a private relay instead of putting it in the public mempool. Now nobody can see it. And so it gets included. I do think, for one thing, you miss out on JIT. Although again, JIT is like pretty rare, so that's one reason. But I think another thing is that sometimes it can cost more and can be higher in latency sometimes. And like you're not, it's not like a perfect solution. to the problem. But yeah, I think it's pretty good. You are trusting like potentially the private relay who's running it, but I don't think that's necessarily a big issue. Like you can use any relay. Yes.
Do you think that this is going to lead to an increase in like chains like Aztec, Penumbra, like ZK privacy chains?
Yeah, do you think it's going to increase ZK privacy chains?
Do you think that this is going to cause people to
Yeah.
towards those one-source flavor?
That what is? Sorry.
Just like everything that's happening right now.
Yeah. I think Penumbra's interesting. Penumbra's a DEX chain that is designed around privacy. And there are other attempts at doing these sort of sealed batch auction blocks. I do think it's an interesting motivation for privacy. And like a very like concrete one, there's sort of ideological reasons for privacy, and there are practical reasons for privacy. But this is like a very profit-driven reason to be private is when you're trading and you don't want to leak your order flow information or get front run or something. And so I think it's an interesting case. I do wonder about on a lot of these, like, can you actually get enough liquidity that it's worth it? And so like one of the things about like a lot of these, CowSwap is an example of batch auction protocol. And a lot of these, protocols, it's like oh, let's create a whole chain, and we'll just like net all order flow that's happening. Is actually even on Ethereum, even on Uniswap, it's not that frequent that there's actually retail like uninformed order flow going in two directions during the same block, right? And so like even on like most popular DEX and the most popular chains, that's not that common. I don't remember exactly how common it is, but it's not that common. And so like most of the time, you're not actually going to be netting against anything. And so it's a little bit like overkill to imagine someone coming all the way to this DEX chain in order to like execute this order in a way that again, like they're sort of there's not enough retail flow there for it to make sense. So I think just the cost of going over to this chain might actually just be worse than the cost of like dealing with whatever adverse selection issues there are in Ethereum. So I would like to, and I'm working on, I would like to solve these problems on Ethereum, like within the constraints that we actually have by the existing mempool and stuff. It's more challenging, but I think it's more fun. So, any other questions? Yes.
Are there any solutions for using time as a parameter? So like if you delay, say LP withdrawals are delayed by one block.
Yep. That was one of the ones we discussed. We were considering doing that for Uniswap to try to prevent jet liquidity. And again, like I think it's an anti-feature to prevent jet liquidity. I think it caused some other issues. Like it was sort of not a great implementation. So I like don't like it for other reasons. But yeah, again, I think sort of anti-feature to try to prevent jet liquidity. Yes.
Well, I have a question. Going back to slippage, if order book disclosure is causing all that slippage, is there a way technically to delay the publishing of the orders publicly?
Well, so the private transaction relay sort of gives you something like this, where if you submit to a block builder who promises not to publish your transactions, then it may not be made visible until it's included on chain. Does that answer your question?
Totally.
Yeah. The other way, by the way, to use time is a colleague of mine and I have a paper called TWAM, which is it's called Time-Weighted Automated Market Maker. And the way it works, it's take like a constant product market maker, right? And then just you're allowed to place like a TWAP order on it, a long-term order on it. And what you do is you say, I want to trade like 1 ETH, but over the course of like the whole day. And what happens is it computes as if it was trading infinitesimal amounts of ETH every millisecond. Right, every infinitesimal moment, you sell like a constant fraction of this ETH over the course of that whole day, and it gets automatically like as if it was like traded against the pool at the current TWAP price in between blocks. And so functionally, there's reasons potentially that could be good. I think when I've talked to like professional traders about it, they're like, oh, that leaks way too much information to say like you're doing this big trade. I'm not really sure. Implementing it with concentrated liquidity is it's not theoretically hard, but it is practically very sticky. So I think I haven't really seen it implemented in a way that I'm very excited about yet. But yeah,
is that allowed currently to have the trades not disclosed for like an entire day or something? Because in public order books, I can see that right now. If I'm trading like options or stocks or what have you.
Yeah. Well, so if you did like you were saying a TWAM. Yeah, like with TWAM, with that particular design, you have to disclose the full order at the time you create it. So yeah, so like that reveals some information. You could cancel it, right? So like it's not necessarily like a hard order. So like maybe again people won't rely on it, but it gets sort of sorry.
fully delaying by like a day or some amount of time
Fully delaying.
your orders.
Oh, the whole order, like just submit an order and just say, like, what's the benefit of that?
Not having as much slippage, right?
If I just execute the whole thing though in like one go a day from now?
No, just not disclosing the order book
Oh.
until after the fact to
What do you-
reduce arbitrage.
What do you mean by not disclosing the order book?
If the issue is slippage, then people can see your order and they can
Yeah,
arbitrage.
yeah, again, I think the private transaction relay thing, yeah, that's what solves that. Well, I think we are out of time.
Let's close on the session.
Yeah.
Thank you, Dan.